Hello friends, welcome to the next chapter of the series of NISM Series 15 Research Analyst Certification Examination. Today we are going to be covering the chapter 4, that is Fundamentals of Research. As you know, once Graham, that is Benjamin Graham, quoted that an investment operation is one which upon analysis promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. So you have to understand this definition very clearly, though it looks like a very simple definition for investing, but there are few keywords which Mr. Benjamin had chosen very carefully. So what are those? The first is investment operation. It doesn't say that it's just investment. It calls investment as an operation. Reason that it requires detailed research and an understanding of available options to determine the suitability for the investor's needs and valuing them appropriately. Second key phrase used is thorough analysis. What is thorough analysis? Thorough analysis involves understanding the business, including its products, customers, suppliers, competition, regulations, and potential risks and opportunities. Third, it talks about safety of investment. We want to make sure that whatever the money that we have put in, at least that remains safe. And how do we do that? We do it by ensuring a margin of safety. That would mean that I should buy shares at a price which is below the intrinsic value. So it doesn't matter what the market sentiments are, at least I will always remain in profit in the long run. Next is adequate return. It refers to earning a risk adjusted return that is competitive with other investment opportunities. So when we say adequate return, one more thing we can always add is inflation. It should beat the inflation, and at the same time it should also remain competitive when you compare it with other investment opportunities. Warren Buffett also emphasizes the same view by a different definition. It says investing is the most intelligent when it is business like. So he is putting a point forward that when you are investing in something, you should treat as if you are investing in a new business. We'll dwell more into that in the coming slides. For now, you have to understand what are the main key takeaways for the investors from these definitions. The first one is that investing is different from speculating. Investing in long-term disciplined process, while speculation is a short-term activity and it often involves leverage. Leverage basically means you are not putting your own money, but you are taking 10 times the money, and you are putting somebody else's money to get a large profit. While in case of investment, you are using your money and you are keeping it for long term so that you get good returns. An investment, no matter how attractive, must align with investors' return expectations, risk tolerance, and investment horizon. Successful investing requires time, effort, skills, and constant monitoring of the portfolio. So, of course, not everybody would be able to do it. So, investors have two options. They have to either develop these skills by themselves, or they should hire a professional whom they can trust, who should be able to do it on their behalf. That's why in our country, since not many people know how to invest in stocks, we have got mutual funds also, wherein you have mutual fund managers who are experts with lot of experience. They are able to decide which stocks to invest in behalf of you. So again, coming to Buffett's definition, that is, investing is essentially like taking part ownership in a business. A commitment to invest should be made only after the research has confirmed that the business viability, attractiveness of the price at which it is available, and these two primary approaches to researching business stocks forms a fundamental analysis and technical analysis. So you have to understand it in a scenario, say when you are deciding to put in some money in any stock, you should think that you are going to own this business from now. Say for example, you have a shop which is running very successfully in the next neighborhood, and somehow the shopkeeper says that, now I'm shifting to another place, do you want to buy out my business? So what would you do? You would not just say yes, of course I will want to buy. You would do a thorough analysis. What are the debts that this person has or the business has, or how much income this business is generating. Is it really a viable business? Is it really generating the profit that I see? So all these type of research you will do, and then you will see that if this particular business is attractive at the price at which it is being offered, right? It can be that this person is inflating the price and telling you, okay, this business I can sell you for this much money, but at the same time you feel that actually this could be also brought in far less money, right? So this type of research you are carrying out when you are making these type of decisions. But oftentimes we find that 80 to 90% of the people who are investing in stock market don't make these decisions like that. Their decisions are influenced by many different factors other than these type of approaches which both Buffett and Graham are saying. So as per the course syllabus, there are two approaches when it comes to researching any businesses or stocks. It's called fundamental analysis and technical analysis. Both of this we are going to be studying in brief in this chapter. First, let's understand what is fundamental analysis. Fundamental analysis, as you already know, it determines the fair value of a business based on the discounted value of its expected future cash flow. You have seen the same definition in the intrinsic value also in the previous chapter. So if you haven't gone through the previous chapters of this video, I would say that please do go through them before you come here so that your basics and terminologies are clear before you jump into fresh concepts. So it assumes that the market may misprice the securities in short run. You can sometimes have market sentiments playing its role, and the prices might say an inflation, or it can see a downfall, but that might not be clearly reflecting what is the actual price or the intrinsic value of the share. But in long term, what has been seen is that all the prices would align towards its intrinsic value. So in a short term, the market can give you very different picture or the price for each share, but in the long run, all the market will come to the intrinsic value of the business which it is being offered. Okay, so that is what the fundamental analysis is. It includes both qualitative and quantitative factors. Many of the time people think that fundamental analysis is only about qualitative factors. No, even it has got quantitative factors, because we look at the management of the company, we look at the economic conditions, we look at the operational efficiency and potential risk. We also look at different type of numbers also when it comes to fundamental analysis. This process is basically carried out at three levels. We call it economic analysis, industry analysis, and company analysis. So if I have to determine how the company would do in the next 5 years, 10 years, first I will study the complete economics, then I will study the industry where this company is operating, and then I would dwell down deep into the company analysis. That is one of the type of the approaches of the fundamental analysis approach. The one which I just mentioned now is called as a top-down approach. Top-down approach would first take into consideration the economy, then it will go down to the industry level, and then it would choose the best players out there in that particular industry. So an example would be, in case of change in the telecom regulations, we might trigger an analysis of the complete telecom sector, and then we will go in deep into the strong companies which are there currently in these telecom sectors, and then would bet on them, right? So that's a top-down approach. Whereas the bottom-up approach is beginning with the analysis of a company's fundamentals first, and first we understood the company's fundamentals, then it will go up and we'll study this industry, and then we will look at the economical factors and how it would get influenced. So some of the bottom-up investors focus on businesses like lead to perform well regardless of the economic cycle. So most of the case examples would be of pharmaceuticals industry, wherein we have found that many of the times those industries have their own cycle which will not get influenced by these economic cycles, because it's a steady demand of pharmaceuticals or consumer goods that you see in the country as vast as India. So in those cases, the bottom up investors would use the bottom up approach, okay, wherein they will study the company's fundamentals, then they would go understand the industry, and then they will only then look at the economic factors coming in role. Next is technical analysis. Technical analysis is all that you know. Most of the times what you see on the TV with big people sitting and telling about whether they should buy the share or not, or whether it's a good time to buy based on the prices, when to enter into a stock, when to exit into a stock. All of that is basically coming from technical analysis, and they strongly believe that all the relevant information that is out in the market is reflected by the stock's price or the trading volume. So instead of examining the company's fundamental, it studies the historical price and the volume patterns to forecast the future price movements. It examines the underlying trend, the trading volume that supports the trend, and the time period over which these factors are observed. Charts such as line charts, bar charts, and candlestick charts are used to identify the trends, support and resistance level, and trading signals. So it's a complete study in itself. We have covered this, and we have also covered it in equity derivatives in a large extent. If you go in for equity derivatives exam after this one, you will understand that this is also one topic we have covered much in detail. But ideally speaking, it is a study of graphs and charts, looking at the pattern of the history and betting on how it will perform based on the historical trend that you are seeing. Technical analysis insights. A trend is considered to be strong when it is supported by high trading volumes, while low volumes may indicate potential weakness. So if there is a stock wherein you see that there's a lot of people buying, that basically means that's a strong trend that you are seeing. While you see there is only few people in the market who are buying at that time, then it's an indication of a potential weakness ahead. If a stock price breaks the support or the resistance level with strong volumes, it indicates the trend has accelerated. So that basically means that if this stock value is going and it is breaking these levels, and then it would mean that this is the right time that you should basically buy into the share or sell into those shares, because the trend has been somehow found to be correct, and that is how the resistance or the support level has broken. Technical analysis is mainly used for short-term trading rather than long-term investing, as it solely focuses on price movements rather than the intrinsic value. And as you know that in a country like India, we are a lot of sentimental people out there, and that's why oftentimes the prices that you see in the market might not be a correct reflection of the intrinsic value of these shares. So that would basically mean that you will find situations wherein the prices are very far away from the intrinsic value, but there are people out there called traders, and the people who bet on these things, also called speculators, because who will solely depend upon these price movements, and they will place a bet and they will also exit very soon. So these type of activities is only good if you are looking for a short term trading. It can be a couple of weeks or months, not more than that. But if you are somebody who is going for long term investment, you should not bet on these. You should do a thorough research, and you should only buy whenever the shares are available at a price lower than the intrinsic value, or you have other reasons fundamentally to think that this company is going to do well in the future based on the management and lot many other different factors. Behavior finance. This is something which is very much common. I would say 95% of the people who are trading currently are trading based on the behaviors. So investment decisions should ideally be based on the analysis of available information. However, in practice, decisions are often influenced by emotional and psychological biases such as fear and greed. These biases can cause market prices to deviate significantly from their fair values, both on the upside and downside. We find that somebody in the TV comes and say, oh, this share is going to do superb, and then you find that a share whose actual value should be only 100 rupees goes to 200, 300, 500. All this happens because of behavioral finance, because many people who find this type of information useful, they go on to buying it, and then more buying influences other people to buy into it, and all of a sudden you will one day see that this will go to 80 levels or 100 levels, which will be coming closer to the intrinsic value of the shares. So these biases are something which is not only in India, but it's across everywhere in the world. Okay, so nothing against India here. We will find this type of behavior across all the people. Even the people who are very well experienced can also have these type of biases. They somehow like one particular company and they don't want to look at the analysis information, which might not be in favor of the decision they want to take. Okay, so that's a behavioral finance. That is a complete different study in itself. So the idea of this chapter was just to give you a sum up of different type of analysis, and I will now continue to the question and answers which are commonly asked. This was rather a very short chapter for this series, and I think one of the shortest chapter, but I hope the concepts are clear. So let's go to the question. Speculation is dash calls made with leveraged funds, unlike investing money, which is a dash disciplined activity for creating wealth. So what is speculation? Speculation is a short-term activity, while investing is a long-term disciplined activity for creating wealth. Okay. Let's go to the next question. Fundamental analysis includes which of the following? We have studied about it. Which of the following is involved in the fundamental analysis? Let's see. Options are A, economic analysis, B, industry analysis, C, company analysis, and D, all of the above. So friends, the correct answer is D, all of the above. Now let's go on to the next question. The time span over which the price and the volume are observed factors in the impact of long-term factors that influence prices over a period of time. State whether true or false. The correct answer is true. Let's go into the next question. In technical analysis, impacts of day-to-day fluctuations in prices is annulled by which of the following factors? So when you see that you are doing a technical analysis, how can you take into consideration the day-to-day fluctuations in the prices that you will see in the chart? You have a very good tool. It's called as using moving averages. So if you use moving averages, you will see a straight line instead of these let's say up and down values, and that is how you can annul the effect of the up and down daily fluctuations. So options are increasing time period of the price chart, B, using liquidity parameter along the prices, C, using moving averages, D, none of the above. So the correct answer is using moving averages. Okay, so once you are using the moving averages, that will help you tackle these daily fluctuations in prices that you see in the chart. So friends, with this we are finishing this chapter. It was a very short and simple chapter, but stay with us towards the end of this series. Watch all the chapters. All chapters are important, and once you have done that, go and attend our mock tests which are available in the mocktestchannel.com called NISM Series 15 Research Analyst, and you will find a lot of questions which are there in these mock tests repeating in your exam also. So all the very best. Take care. See you next time.